Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
He is with a family office called Needle, if I'm saying it correctly. And he's an author of a great book called A CEO Does Only Three Things. Welcome, Trey.
Hey, Mike. Good to see you again.
Yeah, good to see you too. Thanks for coming back on the podcast. And this is the first episode we're doing Riverside Studio.
Oh, good. I feel honored.
Hopefully, I don't mess it up. It's very exciting to use a new platform and great to have you. So what's been new? What's new in your world? It sounds like you are more involved with the family office today than before.
Yeah, absolutely. So we started the office in 2019 and have completed the first 5 years of distribution and investment. Now we have a lot of those chips placed. We're starting to see some returns coming in. Yeah, it's been a weird 5 years, of course. So we started it just as COVID was coming in. We didn't know if that was going to wipe everything out. The portfolio has held up remarkably well. We made a lot of good investments in multifamily, redeployed those investments back into multifamily, and now those are sort of in the doldrums, not really moving up or down. And then, we finally took a lot of positions over in the public markets, which we had not avoided, but not really allocated towards in a long time. And so now we're seeing very good returns, obviously, on those bets. And yeah, just kind of managing everything from the top down, with various contractors, various partners in each of those verticals. And yeah, so that's how I'm spending most of my time these days.
I'm actually amazed you have a multifamily investments that are doing well. A lot of people who have written checks in 21, 22 have had challenges. Now, if you've written checks beyond that, 23, 24, probably got into well-discounted deals. But a lot of people did what you did, invested in 19, doubled their money and, by 21, 22, and then reinvested. And here comes the challenge. These investments are somewhat struggling.
Yeah, that's where we are for sure. We had an incredible 19 and 20. 126% return on that portfolio, and said, gosh, this will probably go on forever. And so deployed all of that 126% return right back into, a host of really good assets. And I don't even know that I would rethink that investment strategy knowing what I knew then, because it was just not possible that we would see interest rates go from 3 to 7.5. It wasn't logical to assume that. And then of course it did. And so most of those syndicator-led type of investments, used a lot of the value add funds in order to pay down and to keep up the debt service and those kinds of things. And so we have 6 investments in that portfolio now. They're not doing great. At least we're not losing them. I know some people are. We're not losing them. And as a matter of fact, I am in the early stages of sort of putting together a distressed property buyout fund. And we'll walk in and, guarantee the notes and put some additional value add in, because I think there's a lot of fatigue from people who says, just get me out and I'm okay. So we're looking at those kinds of things in multifamily now.
Well, what you're observing is absolutely a great time to buy, right? So it's a difficult time to sell. If you have to sell today, you're taking a haircut, if not a big haircut, then a small haircut. And the fact that you have to burn your liquidity to keep the lights on in these deals is, of course, a little bit concerning. But then what else do you do? Have you had to deal with capital calls or any other additional capital needs?
So I have 2 syndicators that I primarily work with, and one of them had written into the documents that there were no mandatory capital calls, which was a really good selling point until you need capital. And so everything that they are raising on top of, if they have already in the portfolio, goes into a special pref. So we've been okay to put additional funds into those investments with the hope that the pref, an 8 to 10% pref, depending on the property, will mature and if we can live through this sort of roller coaster for the next couple of 3 years and potentially get back into a selling environment, I think the LPs will take most of the benefit from having done that with these pref deals. So we're seeing that for sure. A partner and I just bought a new complex, to your point earlier, that this is the time to be buying, and 612 units, and we paid $48,000 a door for it. We have offers at 106 in hand right now. So you can't do that every day of the week. There are lots of people who have had the fatigue who can't stomach the idea of the capital call or who can't raise the capital call. And, the options for them are closing. I don't want to seem predatory in that environment, but to come in and provide a real solution that says you can walk away without getting hurt is a good service and something that I think we can make good return on for the family.
Yeah, that makes a ton of sense. In this environment today, it's the right time to write checks, to buy massive discounted assets. I was just at a conference and the discounts of the peak are so large, almost mind-boggle. What's been your experience? I basically seen you use example of 48,000 a door. What did you trade at the peak?
The people that we are buying that from paid 126,000 a door for that at the peak. And the challenge was, of course, it was a 3.3% Fannie Mae loan or a Freddie Mac loan, Fannie or Freddie. And, it's workforce housing. So this is not something that maybe you and I would love to be living in, but it's 11 minutes from the Atlanta airport. It's a place where baggage handlers, when they get hired on the first time and they don't get good hours to work, they have to be there at sort of 3 a.m. It's a great place for them to be able to sort of start a career. The rents are relatively stable because it's not like they can go down too much more from the peak from where they were. So we think that that is good. My partner is in the property management and asset management space. And so he gets called frequently to say, hey, can you fix this problem for us? He eventually approached me as the capital solution and said, hey, we could fix these things if we owned them, but they can't hire me to pay me the right number to go in and fix the project for them. There's an impasse there. There's something that doesn't work. There has to be an infusion of capital. And so on this one, we just walked in and signed on the note. We took the existing owners off the note and they signed over all of the equity and they walked away, but they didn't have to go through foreclosure. They didn't have to, a couple of them would probably have to have, bankruptcy and that sort of thing. And we were able to acquire it for, probably 50, 60 cents on the dollar.
How were you able to do it without short selling a bank? So
The bank was involved the entire time. All the bank wanted was for somebody to guarantee that the project would be finished. So we had to raise an additional $2.5 million to put into the project, and they wanted to make sure that the note was going to be paid.
Well, my question is, it's just the math, right? The banks typically finance 70% of the purchase price. So a bank finance of a previous owner 75%. If you go below that number, then the bank is got to take a haircut.
It was a 65% loan to value on purchase. And the bank actually offered us some accommodation to say if you wanted to take 5% and put this on the back end and that sort of thing. But the key is rent roll is 77% rented. So there's 20% of the units.
Semi-distressed asset. It's not.
It's a semi-distressed asset. That's right. And the value add didn't make it all the way to the end. So we had to complete the value add. We can lease up, we can get to the high 80s on lease up through the summer, we think, into the fall. And the cash flow in the property today is paying the note. It won't pay anything else, but it was paying the note. So it's a situation that we could come in and raise a very small amount of money, take over the note. Unfortunately, those GPLPs that had done the project initially, they walked with nothing on that. That's not always the goal for us, but on that one, they were quite happy to do so because the GP specifically was in danger of losing a much more profitable project. And so he was willing to sort of cut his losses on this one so that he could save the other. Same lender on both of those.
Yeah, you would usually describe it as a classic scenario. We're seeing this left and right.
Yeah.
Is to buy today at a pretty significant discount. So here you're saying you're peaking over the note that's 65%. So you're effectively getting 35% off the peak of the market when the deal was purchased.
Correct.
Yeah, we see this was a similar deal we closed in Q1 where we paid $79,000 a door while the asset used to be $125,000 a door. If you're on that, it's right around 35% discount. And these numbers are huge. And on top of all this is obviously execution risk.
That's right.
As long as you can confidently execute. And Atlanta is not an easy market to manage. There are obviously rent regulations. It's one of those markets where you hear landlords complaining that it's difficult to evict. I don't know if this property is in an area where I'm in New York City, so it can't get any more friendly here. The tenant, that is jurisdiction, but there are many other jurisdictions that are sufficiently tenant-friendly, making it somewhat difficult for landlords and deal with problem tenants.
I think in terms of the law, Georgia's considered a landlord-friendly state. In terms of
Georgia is Georgia. This is Atlanta, you said.
this is in terms of the two counties where I've had the most experience with the investing, it has very much come down to the commitment of the local magistrate to enforce what the law actually says, and they haven't been willing to do that because they're very tenant focused. So I have one of my sideways projects is in a county next to this county, and we've had that scenario going on for a couple of years now where the evictions are severely delayed and that sort of thing. So you're exactly right on that. There's an execution risk. Can you, once you bring the right team in, once the team is properly funded, you still have another hurdle to go through, which is the compliance process to turn the entire unit into something that somebody would want to live in with good neighbors and good amenities and all of that. So that you're exactly right. There's execution risk involved. Now, for me, on this project that I just mentioned, the smaller of the two projects, I have a great partner for that. So he's an asset manager in the business more than 40 years. He's a property manager in the business more than 30 years. So he's the right partner for that. He found this deal because they called him and said, we need workout on this, and shared with you. On the other project, I don't have that. And so that's a lot bigger challenge for us.
Well, at least today you're getting the assets at the right price.
Yes.
A few years ago, people paid what the market was, and the market was high. And all these battles made it even more difficult. And that's why they're losing these assets and walking away. And you wind up stepping in at the right price per se. So
Yeah, and it's been really difficult also to maintain, the deep pockets of capital. It's been really hard to say, well, gosh, that money is just sitting in the bank and we're earning 4.75%. And maybe if it was deployed, we would earn better. But we keep waiting on the dip in order to buy the dip. It has taken a lot longer to materialize than I thought it would.
yeah, I mean, we can discuss at the bottom of the market, near the bottom. The bottom line is we're heavily off the peak. Whether it's exact bottom, maybe there will be some more corrections. It's really deal by deal, local market. It's a close enough discount where now you're buying with a lot more, let's call it much stronger and healthier risk reward ratio versus a few years ago.
Correct.
Yeah, it's kind of like you said, your cash can sit in the bank and earn 4%, or it can get deployed. It's the opportunity cost. It's the opportunity. It's at risk of missing out on a great opportunity. And a lot of folks have been getting ready for this type of deals. I'm glad to hear that got one of those. I mean, we're seeing same thing. It's not a volume of these deals. It's kind of like a precision surgery. You're getting a deal here or there, and that deal is the right deal. It's not going to be just go buy everything you see. It's just more of find a great deal with the right partner and then have the confidence to execute. As long as you can do that, and essentially in this case, you didn't have to line up a lot of capital.
That's right.
And capital raising has been challenging. And what you said previously, recovery capital, rescue recovery capital in the form of new pref or new mezzanine debt, we've done that too. That's another way to play the market. You could get into existing deals with a new pref equity, and you push all other people back and say, listen, if you want the capital, let me come in, but these are the terms of the new money. It's going to be ahead of all previous money, and it's going to have strings attached per se. But that's how it functions. You're not trying to be a vulture. You're trying to basically invest as a prudent investor. And
yeah, I have the realist turn on my money, right? Yeah, exactly right.
Somebody else's problem is another person's opportunity. It's kind of a strange way to think about it, but this is how it happens. When there's blood in the street, be greedy, right? Be greedy not in a bad manner, but a manner that if you have the capital and you have the courage to act.
Yeah, I think capital finds its best return, right? And so if the return is in multifamily right now because of the distressed space, and you're looking at 18 or 22, or this one project pencils out at about 36%, the capital will find its way to that a lot easier. If it isn't there, then it'll find something completely different, which is also okay. We're doing a good bit of private debt, mezzanine financing debt right now as well, asset-based lending. And, those numbers are coming out between 15 and 18%. And with very good borrowers. I mean, we're not underwriting anyone who isn't a good borrower. That just isn't in the cards for that. That's not risk-based capital for us. If I put that in a multifamily, can make the same amount of money a lot longer time period, then probably I'd choose to do the debt. So the money will always find the place that it's supposed to be, I think.
Yeah, interesting how you put it. As you go up the risk scale, how to put it. You start with the incredibly safe investment, U.S. Treasuries, maybe bank money at 4%, and then you go in the primary debt, let's call it in the 10 to 12% range, maybe 14% range. Keep going up into some level of secondary debt, mezzanine debt. With the proper underwriting, you can get into high teens, even low 20s. A ton of those deals at 20%. And then you start going into equity, and you start looking into, let's call it, very high teens and above. If you can wind up into mid 20s, even higher into 30s. In today's world, underwriting obviously is very different. So it's more conservative. You have to be more careful. The fact that you're coming up with 30% potential return on these deals, that's wonderful. Almost, you don't need these high numbers. You just need to feel that it's a deep buy. There's a margin of safety. Because today, for most investors, it's not the upside. It's the risk mitigation. Don't lose any money, because I already lost a lot.
Don't lose anything because I've lost a lot. Don't lose anything because inflation is insane and it's eating away at the fringes anyway. There's a good bit of that mentality as well. And, I'm a third generation investor in our family office. My task is not to go rebuild the family fortune. My task is not to lose what has been given to me. And, to do that, you have to make moves when the returns are high, and you have to really stay on the sidelines when it doesn't justify the risk, which is the way that I was feeling in most of 23, was that I just didn't feel like there was a lot of good places for us to put our money. We were doing private debt. We were doing certain things. We were buying 10 and 12% coupons and those kinds of things, but it just never felt really good. And then with the uncertainty around the presidential election, that resolved to some extent. And then, we were very thrilled to deploy a lot of money into the public market, knowing that the tariff situation was probably going to be resolved and that it was an uncertainty issue that was causing public market discounts. And so, those plans, knock on wood, so far have played out correctly. But I'm telling you, it was really hard to sit on a lot of cash for the last basically 3 years.
Well, yeah, if you want to learn from Warren Buffett, right?
Yeah, that's right.
When you have so much cash, it's actually easy to sit on it because you're not driven to deploy. But yeah, I mean, the prudent investors typically sit in their hands most of the time, and they act only a few times. And when they act. They really take action.
Yeah.
So I'm glad you're actually feeling more opportunistic about equity. We're recording this in late May 25. And I'll tell you, I feel the same way. I feel it's actually a great opportunity if you can find these deals to buy into these, especially high quality assets. So yeah, I mean, it's great to hear. And then private debt has been the play of the last couple of years in absence of equity investments or fear of being too early to the market. So yeah, it's taken time for the market to settle in, for the distress to put pressure on owners, on the banks to be more cooperative.
Yeah, and I think the banks are the ones that are doing most of the kicking, down the road right now. I had a conversation with a banker last week, and he said, look, very candidly, if we do a recap on this project, I'm not going to get a Christmas bonus. Like, my end of the year bonus is not going to come through. But if I simply do a workout right now with the existing borrower and give them, enough rate relief and then tack the balance onto the back end of the loan, I still get paid my bonus. It's a $600,000 or $700,000 bonus at the end of the year.
That's crazy. So
it's crazy.
The trend is completely wrong.
And he knew that it was wrong. The incentives are wrong. He knew that. But he said, what am I going to do? I can't change the entire system. And, my kids want to go to Vail for Christmas. And, he had his own motivations. And I agree with him. It's not up to him to fix everything. That kind of deal, we weren't able to position inside of that deal.
I understand and I hear you. And the whole banking system is riddled with the incorrect incentives. And the fact that the stock market, the public markets are doing well, I guess on the equity side, not the bond side, the yields are obviously up. I'll add this comment and nothing more. Right? I don't have a crystal ball. I don't know where it's going to go. We have volatility with tariffs, and then it calmed down and the markets calm down, and it feels like they're back to sort of its happy March. But what concerns me most is that it's been this happy March since, I guess, the dip of the COVID and the recovery, and maybe it's still maintaining momentum, but there's a reversion to the mean. If you look at the fundamental of all these investments, I am personally very concerned about PEs of the S&P 500, right? If you look at these 30 plus PE, we're sort of approaching the stratosphere territory. And what's really fascinating is people are still writing checks. It's almost like optimism. When the markets are happy and optimistic, people continue to buy regardless of the fundamentals.
That's right.
And I'm listening to the book right now, not reading, listening. I do that. Howard Marks, market cycles, understanding market cycles. And this is exactly what he talks about. It's the broad optimism and investors not looking at the fundamentals of these investments, and they are disregarding the risk. Risk is a possibility of a loss. But when investors disregarding risk, they're disregarding the possibility of a loss. They're buying because it has done well in the past. Almost perception of risk changes when things are good. Risk in reality is higher, but investors perceiving it is lower. And on the other side, the perception of risk in multifamily today is high when it's in reality it's low.
Right.
Because it's actually trading at a steep discount to reconstruction cost. You could buy it at the right price for existing cash flows and future cash flows. And you could buy it at a great price based on the fundamental reasons, not necessarily based on the fact that it's done well. It's almost contrarian thinking is the way to go, but most investors don't do it. And they seem to be happy with the crypto and seem to be happy with the stock market. And because the price is up, the risk is up. This is as basic as it goes.
Well, if we were to go and buy this site and try to replicate this workforce housing, 620 units, whatever it is, we bought it at $43 a square foot. We would not be able to rebuild that for less than $250 a square foot. And I think we insured it at $254 a square foot in replacement cost.
Yeah, the reconstruction cost. You bought it at a massive discount to the reconstruction cost. Now you have to discount for the age and condition.
Yes.
That the point is exactly, I agree with you. What you just said, I don't see great deals in new construction today because it still costs you to build, but you can get a great deal in existing. This is a very clear example of how you can get a phenomenal deal at a well below reconstruction cost, and people still need to live somewhere.
Yeah. We only have one investment, which is ground up, and it is in a market which has historically been underbuilt and not kept pace with the desire of people moving into that market, which is Asheville, North Carolina. And so we have a new investment that we made in February to be an LP on that project, to go vertical there. And, I think that the turnkey happens October the 15th, and they're already 26% leased up, pre-leased. And so, but that, that's not something we would look to do very often, especially when I can take that same money and go buy at a 1/6 the price of new construction type deal. But in that situation, I hopefully merits it. And I want to have a little bit of new product quality to offset some of the discounted quality that I have in the portfolio as well.
Yeah, it's a diversification play.
That's right.
For that reason, that makes a lot of sense. Let's go back and shift back to the book. I just want to sort of hear if there's anything new that happens. The book is kind of stuck in my head. I've learned a lot from the book.
I appreciate it.
Real basic, simple things I can just tell you. A CEO does only 3 things. It's people, culture, numbers, right? Every day I sort of go to work and I think about it, and it's all about people that I have, the culture, and the numbers. And have any new sort of ideas, developments? The book is great, so obviously let folks consume the book.
Yeah, I appreciate that. Yes.
Writing a new edition, it's so solid that you almost don't need to reinvent the wheel because it's so good.
I appreciate that so much. So a couple of thoughts there. One, we just published a Spanish version of the book because the publisher noticed a lot of traffic for the book coming out of Latin America. And we thought, why not write it in a language, a native language for people there? We also recognize that a tremendous portion of new entrepreneurial businesses are started by Hispanics in America. And, did they ever intend to be a CEO? Probably not, because most of us are sort of accidental CEOs. We always intended to do something else, but then we ended up owning or running a business or something of that nature. So that the Spanish version of the book just published 2 weeks ago and doing very well, Amazon. And there's an audio version on Audible as well for that. So quite happy. I didn't read the book because I don't speak Spanish, but I'm quite happy that has happened. And then we have a series of 3 monographs that'll be published starting in November. So November, June, and November of next year. And these are all of the transcripts and the recordings of the coaching that I have done over the past 4 years with executives inside of this idea. we loaded it all into AI and said, where were the insights for CEOs? What were the real things that they were taking from this, so that I could produce a book that if somebody couldn't come in and be coached by me, they could at least read a monograph, a very thin 180 to 220 page book. I like thin books like that. They're easy to digest. And if you get the point out there. So we had 3 of those. One of them, which was a bit of a surprise to me, was a CEO's guide to meetings. So one of the things that we spend a lot of time on in coaching is making sure that every minute that you spend pays a dividend in multiple ways. And one of the ways that we do that is to eliminate most of the meetings that we take as CEOs, because they are informational, they are performative, but they are not results oriented. They are not the highest and best use of my time at that moment. And so when I do get into a meeting, I want to make sure that that meeting has a purpose, has an agenda, all of the things, that rule of thumb that we know to do well. And so we have that book coming out. We have another book, CEO's Guide to Strategic Planning. This is something that very often CEOs will hire out to people, but I don't think that CEOs do enough strategic planning. Again, if you're only doing 3 things you're supposed to do: culture, people, and numbers, where do those 3 things fit? They need to fit inside a strategic plan. I have a very specific way that I like that done. I plan for 1 year at a time, not these 3 and 5 and 7-year plans that, they never come to fruition because so many things change anyway. And then the third one is a CEO's Guide to Financial Matters, basically, because what I have found is that most CEOs, they're not really trained classically for coming in and running a business on the financial side and a sales side and all of those kinds of things. And most of us feel a little embarrassed that we don't have a full-blown financial education. I have had many clients say, "What do you mean when you say P&L? Exactly what does that mean to me?" Now, does that mean that they're not a good business person? Absolutely not. Absolutely not. But to be able to educate themselves a little bit on that, to be able to understand that, oh, well, maybe I should do this in this manner and not this manner because of the way that it advances my end goal, then, we want to give them some coaching on some financial literacy matters more than anything else. So those are the next 3 books there. And then I am beginning to contemplate just going through the book and doing a second edition where I come in and say, maybe the example of the CEO of Google who isn't the CEO of Google anymore, maybe those kinds of examples could be cleaned up. I don't think that the core offering of the book, which is the culture, people, and numbers, would change at all. But I think we could just spruce the book up for a new sort of generation of readers. The book's been out about 5 years now. We're just shy of 100,000 copies. And I think it could be spruced up a bit as far as that goes. So we probably will work on that in the middle of next year.
Yeah, it makes a lot of sense. I'm just curious from the readership, a CEO of what company sizes? I can imagine the book is really written for not necessarily the biggest companies, more of a smaller company.
Yes.
It's a much bigger audience, number one. Number two, it's the audience that needs help. Big time executives, they have kind of advanced corporate programs to continue to grow their leadership teams. Small organizations, CEO is expected to be a leader, just to be clear.
Yeah,
Right?
for sure.
Well, the leader, the manager in essence, and they're also a leader. And people, it's all about leadership, right? Culture is all about leadership. Numbers is the managerial trait. Like you said, what is P&L? Well, if a CEO that can't understand P&L, then he doesn't know the numbers. It's an important element of the numbers.
That's very true. And I think if we're honest, most of us run businesses where we feel like we're successful if there's something left over at the end of the month. But we're not running them from a financial statement standpoint. Now, interesting to me, I wrote the book for, small to medium-sized businesses. Those are businesses that I have worked in. Those are businesses that I understand. I was invited to what's called Secret Mastermind, which is 50 Fortune 500 CFOs and CEOs to come into the room. They all read the book before you come in, and then they pepper you with questions. And I was very nervous about that because I didn't think that the book's message would hold water for them the same way that it would hold water for the small to medium-sized businesses. They took a poll at the end of the first day of that. I was only invited for the first day, then they go through and do 2 more days. At the end of the first day, 49 of the 50 said that the presentation and the material in the book was relevant to their daily life as a CEO or a CFO. So I was very surprised by that.
Well, it proves that the concept is so fundamental. You could apply to Fortune 500 company CEOs the same way you can apply it to a small company. It doesn't change. Maybe it scales. Maybe they work on a different scale, but the concepts are super solid.
Yeah.
Appreciate the update. It's so wonderful to hear you're making progress on multiple fronts. Obviously, the book and the coaching and the consulting in the area, spreading the wisdom is a great way to influence and impact a lot of people. And also, you are a practitioner, right? You are managing family office, you're writing checks, which is just as important. And so, very happy to hear that. What's the best way to folks to reach out to you if they wanted to speak to you about the book, the coaching, the consulting, or look at one of your deals?
Yeah, I appreciate you asking that. So my website is trey-taylor.com. Got contact information, a little form you can fill out, those kinds of things. People find me on LinkedIn a lot. And so it's Trey Taylor JDE, because I'm a lawyer by training. So you can find me on LinkedIn there. I also have a newsletter. I don't know that we talked about that when I was with you the last time, but it's Plant Your Flag. Yeah. Yeah, plantyourflag.live. And it's just sort of, I don't want to say random, but it's just sort of a thought piece, every time I have something to say. So I wrote a little piece yesterday about the recruiting problem and how that interfaces with the unemployment, issues in the marketplace today. It's just, if you want to hear my take on various business issues, we do that. I do a quarterly update on, the places I've gone and the deals that I've looked at and the books that I've read and that kind of thing. But then interspersed with that is a lot of, mostly political economy, not politics, political economy, and how things sort of affect people who are in the deal making business.
So, what is political economy? Just to be very clear. 'Cause,
Well,
things get very dangerous when you start talking about politics, depending.
yeah, and it's not politics specifically. So you'll never open the newsletter and find that Republicans bad, Democrats good, or vice versa. That's not the point. The point is, when those folks get together and they start making decisions, those decisions affect the economy, and you have to know that as a complete continuous system. And so I talk a lot about I'll be dissecting the new tax plan when it comes out and saying, like, this is what we had hoped for and this is what materialized, and those kinds of things. We had quite a bit of movement inside of the accelerated depreciation and those kinds of things. And what does that mean when you're doing deals, when you're deploying capital and those kinds of things? So that's what I mean by political economy. I did some of my university at Oxford and did a lot of study of political economy.
Gotcha. Yeah, it's the impact of politics on the economy. And
That's right.
you couldn't come up with any more impactful. Politicians they find ways to screw things up in the economy. Every time they do it, they caused inflation by printing money. Now we're dealing with the trade wars, which creates a lot of uncertainty, volatility, and all that stuff. And in theory, all this stuff sounds good. In practice, the economy doesn't like uncertainty. And I think, depending on your point of view, we still want, made in America. We love American made, but some of the things are difficult to see being made in America. I don't think we can ever really do the production of blue jeans or some of the, you know how crazy it is? My wife is an optometrist, and she tells me about the tariffs on the frames that they import from China. And it's getting a little ridiculous and crazy that these frames that go from China to Canada back to the United States wind up with the Chinese tariffs and all kinds of crazy stuff. And the bottom line for small businesses, this is very, very difficult to be able to stay in business, to be able to deliver goods and services and the products and services to the consumer at a reasonable cost when you implement tariffs fast and furious. It's kind of talking about, shocks to the system. We'll see where we wind up from here. And I'll add one more comment. Yeah, the new tax bill, bringing back 100% bonus depreciation should help real estate quite a bit. I mean, it's one of the big tailwinds.
That's right.
For the industry.
So it's interesting. I have a friend that is in the commerce department, and he was on the sort of study committee to give feedback for, proposals for the tax bill, and which we've only seen part of. The big beautiful bill is only a little bit taxed. There will be a more pronounced tax bill hopefully later in the year. And what he was told was that the White House was very specific to say, we want a tax system that promotes transactions. We want people doing business. They will figure out how to make money. They will figure out how they pay their taxes. They will figure all of that out. But we have to take our boots off the neck of the American deal maker. And we want people doing transactions. We want them buying airplanes. We want them buying and selling real estate. We want them transacting in every way that they can, because every time they transact, hopefully value is created. Taxation can come off of that. That's the way that the things have to work. And we just haven't had that mentality in this country in a little while.
Yeah, I appreciate the wisdom. Certainly concur. We definitely have seen very slow transaction volume in real estate, and to pick that up. But one of the important things that I don't know how it's going to get addressed, we actually need a level of lower interest rates. The interest rates is such a critical component of it's a critical driver of transactions, critical driver of the cost of capital, right? And to solve that issue, we need to find a way to basically give the markets incentives to trade, to lower the interest rates. I've seen struggles, and I don't know where we go from here with all the politics aside, where we both need to provide pro-growth tax policies at the same time, keep the deficits under control, and we are certainly out of control. I don't know where we go from here, but it's kind of like a danger zone.
I think that's the distressing nature of it all. I feel like maybe with political consensus, we could come together on so many things, but the reduction of spending is not one of them. And until we fix that, the rest of it is window dressing. If we don't refinance the debt that we have right now that's held at such a high interest rate, which is great for sort of mom and pop investors to be able to have a T-bill that pays 4.5%, 5.5%, 6%. We almost touched 6% in the last Treasury auction a couple of weeks ago. And if we're not able to do that, then the country itself cannot service its own debt. That's a bad thing for us. That's a bad thing for people who do capital allocation. It's a bad thing for the country as a whole. It's a bad thing for the world as well. And so I think that absolutely has to be addressed, and the spending nature of that has got to be fixed. It doesn't matter if you just refinance the debt. If you just go back and add another trillion or $2 or $3 or $4 trillion to the balance, the payment stays the same and you're carrying a larger load, which is very much what we have seen as we started the discussion today in the multifamily space, right? So when those rates adjust upwards, that's when the crisis kicks in and equity is wiped out.
That's exactly a concern today. How do you refinance the debt? The maturities cliff, right? Obviously, all the paper that was bought on floating rate debt has been, causing a lot of grief, and there's been a lot of loans originated 5 years ago, and then as they mature, you got to roll the paper. And it's not just real estate; it's corporate debt.
That's right.
Obviously, government debts, municipal debts. The debt in the system is what's created sort of the well-being in the country, and refinancing of the debt is a serious concern. I don't know where we go from here, but the level of interest rate today, it's not just the level, it's the shock where we were. It's a 0,
That's right.
5.5 push in a very short amount of time, and higher for longer. Sooner or later, it's going to break things. I don't know. We'll see.
And the problem is, right, is that there just isn't a buyer. I don't know if you saw the article that I saw when I was at lunch today, that the big office tower in Portland, Oregon, I think it's called like the Pink Lady or something like that, because it's made out of sort of pink stone, sold for $70 million, which was 1/5 the price that was paid for it 4 years ago. And the only good thing is that there was a buyer out there willing to buy that and use it in such a way. That's a cataclysm if all of the commercial real estate is all of a sudden worth 20% of what it was 4 years ago. That's a big deal.
That's the worst of the worst. That's the one
That's right.
that's been beaten up so bad. I mean, at the end of the day, it's a reset. For the new buyers who could buy at this price, it's a reset. But all that debt on the books, when you have a little bit of a haircut, the system is built to protect the banks. So when you have a 70-30 or 75-25 loan, when the value drops by 25%, banks is still okay, close to being okay. But if you drop 80%, fifth of a price, then yeah.
And somebody probably got their bonus to do that deal up front, and a different guy got the bonus to do the workout and do it on the other side, like we were talking about these, misplaced incentives. So anyway, funny. funny story there.
It was awesome to have you. We can keep going and going. There are a lot of things to discuss. Appreciate your wisdom. It's so good to have you back on the podcast. Let folks reach out. Thank you for sharing your wisdom. Appreciate you. And until the next time.
Yeah, thanks for having me, Mike. Always enjoy these conversations.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.